exam coming up. You've just submitted homework number 4. It was a big one. Number 5 is shorter. Number 5 only has 4 problems. And it's not that those are super hard problems, it's just that you've got less time between now and when homework 5 is due. It needs to be submitted at or before noon on the Monday of next week, the 25th. And that's the same day that we're also going to have our first exam here in class. And the coverage of the exam is essentially everything from the first class meeting up to and including Friday of this week. So this is class 13. It's going to be lectures 1 through 14 on the first exam. And so there's going to be problem-solving questions on the exam. There will be concept questions. I'll provide the factor equations, and I'll provide factor tables if you need them to solve problems. And so what you need to bring with you would be a writing instrument and a calculator that's not your cell phone. So you won't be able to use your mobile phone during the exam, but you should also bring your laptop, because there will be at least one problem where I ask you to use Microsoft Excel. So you've still got some time to study for that. Any questions on the announcements? Remember that the pre-test, you can think of it just maybe like an informal way to gauge your understanding so far. That's posted on Blackboard if you want to use that as a way to study. But that pre-test shouldn't be taken as an indication of how long our midterm will be or precisely which questions or what the format will be. That was just mainly provided as a learning tool. All right, so today we're going to pick up where we left off from Monday's class and talk about capital recovery a little bit more. There was one of the in-class exercise questions on number 12 from last class that we didn't get to. And then we'll talk about some variations on capital recovery, which is capital costs, permanent investments. And then we'll talk about bond pricing. So just to review what we talked about last time with capital recovery is that there's 2 pieces that goes into determining the capital recovery. Capital recovery, you can think of it as how much additional revenue would you have to make each year in order to cover the cost of acquiring equipment. Not maintaining or operating the equipment, just the cost of acquisition, which by that what we mean is the annualized first cost minus the annualized salvage value. Because when you purchase equipment, it costs money. When you sell it at the end of its useful life, that's a revenue to you. So the difference between the inflow and the outflow will tell you the capital recovery. So if we look at the formula here, what you're doing is you are taking a present value, which is the purchase price, and you're annualizing it with find A given P at whatever the given interest rate and number of periods are. So you're finding an annual equivalent, the economic equivalent of the initial purchase price, and then you're subtracting out the annual equivalent of the salvage value, S. So you're finding A given F. Now keep in mind the general form of find A given F is if we have a certain number of years, so 1, 2, 3, 4, 5, an annual series, which is an uninterrupted stream of either inflows or outflows. If you wanted to find F given A, the F that you'd be finding is in the same year as the last amount. That's a little bit different from how P, an annual series, works, where P is a year before the annual series begins. In the case of future values, it would be in the last year as the annual series. So in the case of the salvage value, when you find A from the salvage value, you're spreading out that sales value of the item that's being disposed of into an annual series. And so capital recovery is the difference between the purchase price and the salvage value, both of which have been annualized. So this last question that was in the in-class exercise, where you're purchasing a septic pump truck today for $85,000, and in 6 years it will sell for $18,500. We're given that the interest rate is 8%, and we want to know the capital recovery amount. So let me sketch out what the cash flow diagram for that is going to look like. So we've got a time frame of 6 years. So we initially spend $85,000 at time 0, and that's a lump sum present value of $85,000. And then we've got 1, 2, 3, 4, 5, 6. At the end of the 6th year, we sell it for $18,500. So what we're trying to find out is what is the annual equivalent of how much additional revenue would you have to make. Now, whether it is an arrow down or an arrow up is really just a matter of how you phrased the accompanying language. So if I said, for example, this is what we're trying to find, is the annual equivalent of these two amounts, A equals what, I'd find some amount, and then in the answer I'd say, you should earn an extra, and then I'd say whatever A is, each year to cover the capital recovery cost. All right. So we've got the factor table, the 8% factor table. So what we're going to do is we're going to, with the 85,000, we want to find A given P for I equals 8%. And n equals 6, and then we're going to take 18,500 and find A given F, I equals 8%, n equals 6, and then we're going to find the difference between the two. So when we combine them, one is an outflow, one is an inflow, so they need to be subtracted. All right, so let me pause and give you a chance to use these factor tables here to find out what's the annual equivalent of the purchase price, the salvage value, and then combine together the capital recovery. Okay, so using the 8% table, you look up the find A given P factor. It's 0.21632. That has 1, 2, 3, 4, 5 digits, and so does the other factor, which means when we get to the end, our final answer should be accurate to 5 digits, and we shouldn't report any additional precision beyond that. So I'll round off at the end to 5 digits. So there's a cost, which is minus, a revenue, which is plus, and combining them together, that means that how much additional revenue you should earn each year is $15,865. And so that means that needs to be money coming to you because you're going to be paying each year a certain equivalent for the equipment. So the revenue you should earn is a positive amount in order to balance out the cost of owning, just having the equipment itself. So that's capital recovery. Now, down at the bottom of the slide here, there's just kind of like an extra question about a permanent investment. And we'll talk more about permanent investments. Those are things that last forever. Like if you build a bridge and it has a useful life of 200 years or longer, in economic terms, that is effectively infinity, because revenue beyond 200 years has essentially no present value because of the effect of compounding over such a long period. But the way that you'd answer this question, if you spend $85 million to build a bridge that'll last forever, what is the capital recovery for that investment? There's no salvage for something that lasts forever. So there's not a revenue at some point in the future. There's just the cost at the present. And what you're doing is you're spreading out that cost over infinity. So if it goes on forever, you're starting here at time 0 and you spend $85 million, what we're trying to find out is what is the annual equivalent of that forever, 1, 2, 3, 4, 5, and so on, what is A? And the way that we do that, for I equals 0.047, A is P times I for something that will last forever. And so we would just simply multiply the 85 million by 0.047, and that tells you that the annual equivalent of that is $3,995,000. So if you were building a bridge and you knew it was going to cost 85 million, then what that effectively means is each year you should try and get at least $3.995 million in revenue in order to justify the initial acquisition cost. You'd probably also need some additional revenue on top of that to cover things like repainting the bridge, the people who maintain and inspect it, so those operating costs. But we're just talking right now about capital recovery, which is spreading out the initial acquisition over a series of annual amounts. And if the annual amounts extend forever, then the relationship between A and P is pretty simple. And we'll talk more about that. But any questions about the first part of the problem, the septic pump truck? Hopefully by now, these cash flow tables are becoming second nature to you. I hope that by now you're very familiar with how to use them. Now keep in mind that in the exam, if you have a factor, like a table lookup method type problem, I'm not just going to give you one interest rate. So you'll need to make sure that you use the right interest rate table. I'll maybe give you the 4%, the 5%, the 6%, the 7%, and you're going to need to make sure that you use the table that corresponds to the correct interest rate. So that's a mistake that occasionally I see people make, is just they pick whichever first table they lay eyes on, and it may not correspond to the interest rate of the problem. All right, so annual income forever. If you have some sort of an investment you make, if you buy some equipment, or let's say you buy a business and you anticipate holding on to it forever, or let's say you make a deposit into a savings account, and if the savings account was 4%, how much could you withdraw each year so that the principal is never exhausted? And this is simpler than, you had one problem where you put a certain amount of money into an account and you were taking out $5,000 every year, but it only earned 4.5% interest, and so the account balance was decreasing, and eventually you ran out of money in that homework problem. I think it was homework 3. This one is just saying, how much could you withdraw so that you never run out of money? And that same relationship holds that I just showed you for the capital recovery on a permanent investment. For an infinite series, the annual amount that you can withdraw is simply the principal times the interest. So doing that, withdrawing the interest each year never touches the principal, so that next year's annual interest payment is the principal times the interest rate. You withdraw it, and the principal remains untouched. So withdrawing $4,000 each year from this account would allow the account to continue paying interest forever. So if we look at the 4% table in the back of the book and go down through lots of different rows, what's interesting to look at is the A/P column. It gets closer and closer to 0.04, which this is the 4%. If you extend it beyond 100 years onto infinity, then the ratio of A to P is simply 0.04. So that's find A given P for 4% and infinite number of years, then the factor that you'd use is 0.04. So that's just kind of a table illustration of that same principle of a permanent investment. And so if you were trying to find out the inverse of that, which is how much is the present amount if the annual amount is given over time. Find P. It's simply A divided by I. So, for example, what's the present cost that you'd have to deposit today? How much would you have to put into a bank if you wanted to be able to withdraw $50,000 a year forever? You know, for a certain interest rate, you'd simply divide the annual amount by the interest rate, and then that tells you how much you need to deposit at time 0 in order to make that series of withdrawals over time possible. So A is the interest on a perpetual investment, and so if it was a 10% interest rate, then you'd need to deposit $500,000, which is $50,000 divided by 0.1, in order to be able to withdraw $50,000 each year forever. Any questions? So there are certain things that do last for so long that it's effectively forever. Dams, canals, bridges, and to find the capital recovery of those, we simply multiply their present worth by the interest rate, and then that'll tell you the annual equivalent. All right, now let's talk about bonds. And we're not talking about James Bond, we're not talking about Barry bonds, we're talking about the investment type where it's a certificate or a legal agreement that you make with an organization or a government where you provide them with a lump sum payment now, and in exchange for that, they promise typically to give you a series of interest payments over time and then a lump sum return of your principal at some date in the future. That's the most typical kind of bonds. There are other variations. There are things that are called zero coupon bonds where you don't earn the periodic interest and you just get a single lump sum at the end of the bond's life. But most typically, bonds have two pieces to them. And we're going to be talking about how you calculate the value of a bond. I've just recently started buying bonds using Charles Schwab. Anybody have a Charles Schwab account? One? All right. You should start thinking about investing because you're going to have money. It may not seem like you have money now, but in a few years, you're going to start getting a salary and you're going to want to find ways to invest for the future. And bonds that are issued by the U.S. government are considered to be pretty safe investments because they're backed by the full faith and credit of the U.S. government, which has never defaulted on its financial obligations before in several hundred years. And you can also buy bonds from companies, and companies are rated based on their credit worthiness by different rating agencies, where AAA is thought to be the safest investment grade of corporate bonds, and less stable companies have lower ratings like single A and double A, and the more risky those companies are perceived to be, what you'll notice is that the interest that they pay is higher. So if you compare a company that's issuing a 2-year bond, if you went to Charles Schwab today, you could buy a AAA rated bond and it would yield 5.08% interest, whereas a single A, which has more risk associated with it, pays a higher rate of return. So that's one of the trends that you should be aware of, is that really stable investments are considered less likely to default, and therefore the interest rates are lower. But default isn't the only risk. Earlier in the semester, we also talked about interest rate risk. And interest rate risk, as I hope you recall, is the idea that in the future, if interest rates went up and you were holding on to a bond at, let's say, 5%, and now the bonds are paying 6 or 7%, you're losing out on the money that you could have made by investing later on in the higher yielding securities. So part of the interest rate that you see is determined by what people think interest rates are going to do in the future. They call it the yield curve. And right now we're in sort of an interesting situation where they have an inverted yield curve. In more typical times, what you'd see is the highest interest rate for the longest bond term. So ordinarily, you'd see that the 30-year interest rate would offer the highest yield, but that's not the case right now. Right now, the highest yield for U.S. Treasuries looks like today it's 6 months. So what that tells you is that the consensus view among investors is that in the future, interest rates are likely to be lower than they are now. So that's really complicated, the idea of the yield curve. I don't expect you to know or understand that, but what you should be able to do is price a bond. And so I'm going to show you the formula for how to price a bond. And the trend that I hope you'll remember from this figure is that more secure companies offer a lower yield than less secure companies. Anybody know what municipals are?
Is it like a local government?
Local governments, yeah. So not just the federal government can borrow money with bonds, but local governments can as well. Yes?
I just wanted to ask a question. So what's the difference between bonds and regular investment in a stock?
Yeah, when you buy a stock, you're essentially becoming a co-owner of the company. So you are what's called an equity investor. And equity means ownership. When you buy a bond, you're just making a loan. And you're not a co-owner of the company. You're not entitled to their future profits like a shareholder is. But they owe you a certain fixed rate of return, whereas stock shareholders aren't legally entitled to a certain rate of return. They just have a share in the possible profits.
So like bonds doesn't guarantee you're going to make money back?
I wouldn't say guarantee, but the rate of return you're supposed to get is defined by contract. The company that sold you a bond may go out of business, and in cases like that, the bondholder has senior status to stock shareholders, so they usually would get more of their money back if the company goes out of business. But bonds are considered safer than stocks. Yeah.
Is another way to lose money in a bond is if your inflation rate is higher than the rate of the bond?
Yeah. That's true with every investment, whether it's a savings account. If your yield in the account is lower than inflation, then your purchasing power is decreasing. So municipals are local governments, and the reason why the rate of return is lower for municipals, it's not because they're super safe, because municipal governments are less secure than the federal government. But what's advantageous about municipal bonds is typically they're free of paying income tax. And so if you own municipal bonds, you don't have to pay state or federal tax on those. And so municipal governments can get away with offering a lower rate of return because they know that the money you make is not taxable on that. All right, so there's two pieces of money that you get when you buy a bond. The two components is, number one, you're going to get some interest back, and that's going to be a series of payments through time, like an annual series. And then the second component of the value you get from a bond is a lump sum payment at the end of the bond's life. And most often that's the return of your original principal coming back to you. It might be that the principal amount that your initial purchase price is different from the lump sum payment in the future. And the formula I'm going to show you has different variables for those two things in case the lump sum future payment is different from your initial purchase price. But this is always true, that there's two possible sources of value in a bond, the interest and the lump sum payment in the future. So here's the formula for a bond's value. And I hope that you're not intimidated by this formula because it's nothing you haven't seen before. It's just business as usual. What it's saying is the two pieces of value to a bond is the value of the redemption price, so that lump sum in the future, which is C, the redemption price. So like if the company promises to pay you back $100 30 years in the future, what we're doing with this first component is finding what is the present value of that $100 that they're going to pay you 30 years in the future. The present value isn't $100 because they're paying you $100 many, many years in the future. So we need to discount it to the present with find P given F. And the interest rate that you discount with is called the yield. So I, in bonds, is the yield rate per period. There's two different types of interest rates in a bond. There's the yield rate, and then there's the bond rate, sometimes called the face rate of the bond. So the first part is that lump sum. What's the value now? The second part is the value of all the interest payments over time. So R times Z is how much interest you get each period. So Z is the face value of the bond, and if the bond's rate was 5% and the bond's value is $100, then that would be $5 in interest if it's paying it out annually. So you're finding out the present value of a series of payments with find P given A. So we're going to work through a problem to help you understand how to price a bond. Let me hand this out. Okay, I've got the variable definitions and values up on the screen. Since it's semi-annually, then a 10-year bond will have 20 periods. If it was quarterly, then you multiply by 4. If it is every month, then you'd multiply by 12 in terms of N. For the rates, then you'd divide. Because that is how much they pay you. It's redeemable at its face value. So that means the face value is 100 and the redemption, the face value is 1,000 and the redemption is 1,000. Is up here on the screen now. The present value of the bond is $864.10. If we round off to 4 digits because of this P/F factor. So the two pieces of value in the bond is the present value of the lump sum payment at the end and the present value of the interest payments over time. And if we combine those two pieces of value together, then it tells us the present value of the bond is $864.10. So you need to be careful about reading the problem statement and seeing how frequently the bond pays out. So what is the number of periods per year? The other caution I'll give you is that you don't necessarily need to be told what is the bond rate, R. If you're told how much the interest amount is directly, R times Z is the interest amount. Sometimes you'll be told what is R times Z combined together. And if you know R times Z, then you don't need to know them individually. And that's what will be the case in the next problem that we look at. Any questions about problem 1 before we move on to solving a couple of problems using Excel, a couple of bond problems? Okay, these next two problems, I intend for them to be more of a demonstration because it may be hard to set it up yourself if you've never seen one before. So you're welcome just to watch, or if you want to follow along with Excel, that's great too. Here is problem 2, what we're going to look at. You wish to invest in bonds that have a face value of 100. The bond rate is 6.5% per year, and that's the nominal rate. That doesn't take into account compounding. The bond interest payments are twice per year. In 25 years, the bonds are redeemable for $200. If you're willing to accept a yield rate of 5% per year, then how much should you be willing to pay to purchase the bond? So what do we know? Let me just set this up. We want to know N. What is N in this problem?
25.
It's 25 years and it's paid twice per year. 50. So equals 25 times 2, 50. Okay? R, the bond rate per period. By the way, I'll define these up to the side here. Number of periods before redemption. Okay? R is the bond rate per period. Okay, what is the bond rate per period here? It says the bond rate is 6.5% per year, so 0.065 divided by 2. So the bond rate per period is 0.0325. Okay, I, which is defined as the yield rate per period. What's the yield rate per period? 0.05 divided by 2. So it's the yield rate per year divided by the number of periods per year. Okay, C, which is defined as the redemption. The bond is redeemable, it says here, for $200. So 200. And Z, which is the face value. This bond has a face value of $100. All right. So R times Z, which is going to be the interest amount per period, R times Z. So every 6 months, if you own one bond, you'll get $3.25 of interest. So that's R times Z. Now, does anybody remember what are the two pieces of value in a bond? There's the PV of the redemption at the end of the bond's life, and then there's the PV of the interest payments. Okay, so PV of the redemption at the end of the bond's life. Here's the redemption at the end of the bond's life. We want to find out today what is $200 in the future worth. If you're getting $200 50 periods from now, what is the present value of that? So I'm going to do PV. All right, so I'm doing the function here, and it says rate. Remember, on the equation, the rate that you're supposed to use in finding the two pieces is the yield, I. R is the bond face rate. I is the yield rate. Okay, so the rate that I'm going to tell it is the yield rate per period. Okay, NPER, it's 50 periods. And now, this lump sum of $200, should I put that in the field of PMT or should I put it in the field of FV? FV. And why is that?
It's not a payment, it's like what you're receiving.
It's not a recurring amount. PMT means like if it's a recurring amount that happens over and over and over. FV means it's a single lump sum amount. And this redemption price is a single lump sum amount. So I'll do comma, comma, minus of the redemption. Okay, so that $50, I'm sorry, the $200 50 periods from now has a present value of $58.19. And then the payments over time, $3.25, I'm going to do PV. The rate should be the yield rate. NPER is the number of periods. And now PMT. If I put an amount in there, what Excel is going to assume is that there is a recurring annual series, which is what this is. That it's a uniform series of $3.25. So I'll put minus of this interest amount, and I'll find out the present value of the interest payments. So $92.18 is the present economic equivalent of having 50 payments of $3.25 over time. If you discount all of those payments of $3.25 every 6 months for 25 years, the present value of those payments is $92.18. So therefore, the overall present value So the total value of the bond at the present is the value of the lump sum and the value of the interest payments. So this bond is worth $150.37. All right, it's 12:48. I don't think we have time to do the last problem, so we'll pick that one up in class on Friday. Now, it's very important that you come to class on Friday because I'm going to be telling you what the class project is. I'll be introducing the class project that day, so it's a big part of your grade and important to understand. So I'll see you then.